So Alibaba, it's got to be one of the most complex and honestly most debated companies on the planet, right? But today we're going to cut through all that noise. We're getting past the simple headlines to build a proper framework for understanding its real value, layer by layer. All right, let's jump in.
So this really is the central puzzle, isn't it? I mean, how can a company of this scale, we're talking nearly $1 trillion RMB in revenue, a true tech giant, still confuse so many smart investors and analysts? It's kind of wild. And well, that's exactly the question we're going to unpack in this explainer.
Okay, first things first. We have got to throw out the most common, and let's be honest, kind of lazy comparison. You know the one? The Amazon of China. Look, maybe that was a helpful shorthand, I don't know, a decade ago. But today, that label, it actually hides more than it reveals. It doesn't really tell you how the company actually makes money or where it's truly going. So let's ditch it.
So here's how we're going to tackle this. First up, the valuation puzzle itself. Then we'll deconstruct the company into 4 distinct layers: the cash engine, the cloud option, the growth bet, and the big discount. And finally, we'll put all those pieces back together.
All right, let's get right into it with the core problem, the valuation puzzle. Because when you first look at Alibaba's financial statements, they can seem, well, all over the place. And without the right framework, it is incredibly easy to draw the completely wrong conclusions.
Okay, now look at this. This is where things get really interesting and really confusing. On one side, you've got the full year results, a massively profitable company. Looks great, right? But then you look at the most recent quarter. Revenue barely nudged up, but operating income, it plunged by a staggering 74%. You can see why the market is scratching its head. This right here is the source of all the confusion.
So this immediately makes you ask the question, what on earth is going on here? How do you reconcile these two completely different pictures? Is the business just quietly falling apart, or is there something else happening just beneath the surface?
And here's the answer. This wasn't an accident or a sign of weakness. Actually, management has been crystal clear about this. The profit drop was a deliberate choice. They decided to aggressively reinvest in key strategic areas, shoring up their domestic e-commerce, fueling their international growth, and pouring a ton of money into cloud and AI. So you've got to see this as a strategic push, not some kind of cyclical panic.
And that brings us to our first layer of analysis. And folks, this is the most important one, the cash engine. Think of this as the absolute bedrock of the entire company. It's the financial foundation that pays for everything else.
So what is this cash engine? Well, it's their core China commerce business. We're talking Taobao and Tmall. It's this mature, incredibly profitable marketplace that just prints money. It generates enormous cash flow from merchant ads and commissions. From a valuation perspective, this is the floor. It's the durable, cash-gushing foundation of the whole enterprise.
Okay, let's move to the next layer, which is arguably the most exciting part of the story, the cloud option. This is the segment that really holds the key to a potential re-rating from the market. You know, where investors might fundamentally change how they value the entire company.
And this chart illustrates exactly why. The numbers are just so compelling. Overall cloud revenue is growing at a healthy 13%. But just look at the AI-related products. We're talking triple-digit growth. That is absolutely explosive. It's this high-potential business hidden inside the larger, slower-moving conglomerate. So here's the crucial point. If these investments in cloud and AI continue to pay off, the market might finally stop seeing Alibaba as just a big, mature e-commerce company. Instead, it could get revalued as something much more dynamic, a hybrid commerce and infrastructure platform. And let me tell you, that category typically commands a much, much higher valuation.
All right, on to layer 3 of our framework, the growth bet. This is primarily their international commerce division, a segment with enormous potential, for sure, but one where the path to profitability is, well, a lot less certain.
And the potential is undeniable. Just look at that number. A 32% revenue growth rate in a single quarter is seriously impressive for a business of this scale. It shows their international strategy has real, powerful momentum behind it.
But, and this is a big but, fueling that kind of growth is incredibly expensive. The segment is still losing money, and that is precisely why we call it a bet. Its ultimate value isn't based on today's revenue, but on its ability to one day convert that rapid growth into sustainable profits.
And that brings us to the final piece, layer 4. And for many investors, it's the most frustrating one, the big discount. This is the persistent anchor that just weighs on the stock's valuation, seemingly no matter how well the individual businesses are performing. This discount is really a cocktail of factors. You've got the complexity of the company itself. It's just hard to analyze. The market has a long memory of past regulatory crackdowns. There are broad concerns about China's economy and, of course, geopolitics. These are real, unavoidable headwinds that just keep that valuation multiple suppressed.
Okay, so we've broken the company down into its 4 key layers. Now let's put them all back together to build a much more intelligent framework for thinking about Alibaba's real value.
First, let's be super clear about what not to do. Trying to value this entire complex company with a single, simple metric like a price-to-earnings ratio is just lazy. It's guaranteed to give you a misleading picture because it mashes mature cash cows together with these high-growth, money-losing bets. It just doesn't work.
The much smarter approach, the one serious analysts use, is a sum-of-the-parts analysis. And really, it's exactly what we've been doing here. You break the company down, you value each piece on its own merits, the cash engine on a cash flow multiple, the cloud business on a growth multiple, and then you just add them all up.
And this table right here brings us to the most useful mental model from our entire analysis. You can now see Alibaba not as one big, messy company, but as these 4 distinct layers. The China Commerce Core provides the valuation floor. The cloud and AI business offers the clearest path to a higher valuation. The international segment is your high upside growth option, and that ever-present discount? Well, that's the reason the stock so often looks cheap.
You know, I think this single sentence from the source material just captures the entire thesis perfectly. It highlights the core tension. You have this phenomenal cash machine and an exciting cloud option, but they are both trapped inside a complex structure that the market is inherently skeptical of.
And that leads to the final balanced conclusion. The bull case is clear. If the core business stays strong, if the cloud segment keeps delivering, and if the market slowly starts to appreciate the quality of the company's best parts, then yes, the stock could be significantly undervalued today. Which leads us with the ultimate question. After breaking it all down with this framework, what do you see? A deep value trap destined to look cheap forever because of those structural discounts? Or a misunderstood giant patiently waiting for its highest quality segments to finally be recognized by the market? That right there is the real debate.